Imagine opening a business where millions of people voluntarily hand you their money every day. They trust you to keep it safe, expect instant access whenever they need it, and often accept almost nothing in return. Now imagine that, while their cash quietly sits in your hands, you use it to generate billions of dollars in profit. It sounds like the plot of a financial thriller, yet this is exactly how modern banking works. Most people assume banks make money because they have enormous vaults filled with cash. Others believe banks simply collect deposits, lend those same dollars to borrowers, and pocket a little interest along the way. That explanation sounds reasonable, but it barely scratches the surface. In reality, the world's most successful banks are built on something far more valuable than money itself. The true product isn't cash. It's access to cash. It's the ability to connect savers with borrowers, manage risk, create liquidity, and keep the entire economy moving. Every paycheck deposited, every mortgage approved, every credit card swipe, and every business loan contributes to a system designed to generate income from the movement of money rather than the ownership of it. That's why many of the largest banks consistently rank among the world's most valuable companies. They don't manufacture smartphones, build cars, or drill for oil. Instead, they operate the financial highways that nearly everyone uses every single day, whether they realize it or not. Once you understand how this system actually works, you'll never look at your savings account, your mortgage, or even your debit card the same way again. You'll begin to see that nearly every ordinary financial decision feeds into a business model refined over centuries and scaled to an astonishing level. But before we can understand how banks earn so much from money they don't truly own, we first need to examine the single resource that makes the entire machine possible: your deposits. Every successful business depends on a resource it cannot operate without. A bakery needs flour. An airline needs airplanes. A technology company needs talented engineers. For a bank, the most valuable resource isn't gold, cash, or expensive office buildings. It's deposits. Without a steady flow of customer deposits, even the largest bank would struggle to generate meaningful profits. Think about your own paycheck. It arrives in your checking account, where it may sit for days or even weeks before you spend it on rent, groceries, or bills. During that time, you probably aren't thinking about your bank at all. But from the bank's perspective, your paycheck has become part of an enormous pool of funding that helps power its entire business. This is why banks compete so aggressively for customers. Free checking accounts, mobile apps, cashback offers, and attractive savings promotions aren't simply acts of generosity. They're investments designed to attract deposits, because deposits are remarkably inexpensive compared with almost every other source of financing. Imagine two companies that both need $10 million to operate. One must borrow that money from investors at high interest rates. The other receives $10 million through customer deposits while paying only a tiny amount in interest. Which company starts with the bigger advantage? The answer is obvious, and banks have been leveraging that advantage for generations. Suppose you deposit $10,000 into a savings account earning just 0.5% annually. To you, the return feels modest. To the bank, however, that same money becomes relatively low-cost funding. If portions of those deposits eventually support loans earning several percentage points more, the difference between borrowing costs and lending income begins to create a powerful stream of profit. Multiply that process across millions of customers, and even small margins become enormous. The key insight is that deposits aren't simply money sitting idle. They're the raw material banks transform into financial products, relationships, and long-term earnings. Every new customer strengthens the foundation on which the institution can grow. But if banks rely so heavily on deposits, an obvious question follows. Do they simply keep every deposited dollar safely waiting inside a vault? Or is something much more surprising happening behind the scenes? Here's where banking starts to feel almost unbelievable. If every customer walked into a bank tomorrow morning and asked for all their money back in cash, the bank couldn't do it. That statement sounds alarming at first, but it isn't evidence of fraud or failure. It's simply how modern banking has been designed to function for generations. Many people picture a bank as a giant vault packed with stacks of bills, each bundle patiently waiting for its rightful owner to return. Movies reinforce this image with enormous safes, security guards, and mountains of cash. Reality is very different. Most of the money inside today's banking system exists as digital balances moving through computers, not piles of currency sitting on shelves. When you deposit money, the bank doesn't intend to let every dollar remain idle forever. Instead, it keeps enough highly liquid assets to satisfy normal daily withdrawals while putting the rest to work throughout the economy. Regulators require banks to maintain capital, liquidity, and risk controls, but they also recognize that leaving every deposited dollar untouched would make lending and economic growth far more limited. Imagine a simplified example. A bank receives $100 million in customer deposits. Rather than locking the entire amount inside a vault, it maintains sufficient liquidity to handle expected withdrawals and uses much of the remaining funds to finance mortgages, business expansion, auto loans, and other productive activities. Those borrowers spend the money, which often finds its way into other bank accounts, creating new deposits elsewhere in the financial system. This continuous cycle is one reason modern economies can grow much faster than they otherwise would. Businesses gain access to capital for expansion. Families purchase homes without saving for decades first. Entrepreneurs launch companies using borrowed funds that may eventually create jobs and generate even more economic activity. In other words, deposits don't simply sit still, they circulate. Of course, this model depends on one critical ingredient: confidence. On any normal day, only a small percentage of customers need large cash withdrawals at the same time. But if fear spreads and everyone rushes to withdraw their money simultaneously, even a healthy bank can experience enormous pressure. This is what's known as a bank run, where panic, not necessarily poor lending, creates a dangerous situation. Understanding this system changes the way you see banks. They're not warehouses storing cash. They're financial intermediaries constantly balancing liquidity, lending, regulation, and trust. That balancing act keeps economies moving, but it also reveals something even more important. If deposits provide the fuel and lending keeps the engine running, then where do banks earn their biggest profits? The answer lies in the loans themselves. If deposits are the fuel that powers a bank, then loans are the engine that turns that fuel into profit. This is the point where many people realize they have been looking at banks the wrong way all along. Banks don't celebrate when money simply sits in an account. They celebrate when that money can be safely transformed into loans that generate predictable income for years, sometimes even decades. Consider a typical mortgage. A family borrows money to purchase a home and agrees to repay it over 30 years. Every monthly payment includes interest, and that interest becomes a steady stream of revenue for the bank. Multiply that by thousands of mortgages, and suddenly you're looking at a business capable of producing billions of dollars in long-term earnings from a single category of lending. But not every loan is equally profitable. Mortgages usually carry relatively low interest rates because they're backed by valuable property and tend to be less risky. Auto loans often generate slightly higher returns, while business loans vary depending on the borrower's financial strength and the project's risk. Then there are credit cards, one of the most profitable lending products in the banking industry. With interest rates that can exceed 20% in many markets, responsible customers enjoy convenience, while customers who carry balances create substantial revenue over time. Of course, higher returns almost always come with higher risk. Banks can't simply approve every application that lands on a loan officer's desk. They invest enormous resources into evaluating borrowers before making a decision. Income, employment history, existing debt, repayment habits, and credit scores all help determine the likelihood that a borrower will repay what they owe. Imagine two people applying for identical personal loans. Both earn similar salaries, but one has consistently paid bills on time for years, while the other has missed multiple payments and carries significant debt. Although their incomes look almost identical, the bank sees two completely different levels of risk. One applicant may receive a lower interest rate or immediate approval, while the other could face higher costs or even rejection altogether. This careful screening isn't about being unfair. It's about protecting the bank's most valuable asset, confidence that borrowed money will eventually come back with interest attached. Every default reduces profits, forces the bank to absorb losses, and limits its ability to make future loans. Even so, interest income tells only part of the story. The world's most successful banks have discovered countless other ways to earn money from everyday financial activity, and many customers never even notice them. Ask most people how a bank makes money, and you'll probably hear the same answer. Interest on loans. While that's certainly one of the biggest revenue sources, it's far from the whole story. In reality, the smartest banks have spent decades building businesses that generate income every time customers interact with the financial system, even when nobody is borrowing a single dollar. Think about an ordinary Saturday. You buy a coffee using your debit card, order groceries online with your credit card, transfer money to a friend, withdraw cash from an ATM, and exchange currency before booking an international vacation. None of those actions feels significant on its own, yet together they create multiple opportunities for banks to earn revenue. Take card payments, for example. Every time you swipe or tap your card, several companies work together behind the scenes to complete the transaction. Banks often receive a portion of the processing fees through interchange and payment services. The amount earned from any single purchase may seem tiny, but when millions of transactions happen every day, those small fees become an enormous and highly predictable income stream. Banks also generate revenue by serving businesses rather than individuals. Companies need payroll services, cash management, payment processing, foreign currency exchange, commercial lending, and treasury solutions. These services create long-term relationships that are often more valuable than a single loan because they produce recurring income year after year. Then there's wealth management. As customers build savings, many banks encourage them to invest in mutual funds, retirement accounts, financial planning, insurance products, or managed portfolios. Instead of earning only interest, the bank may collect advisory fees, management fees, or commissions while helping customers grow their assets. In other words, a customer who no longer needs to borrow money can still remain highly profitable. This diversified approach explains why the strongest banks aren't dependent on one source of income. If mortgage demand slows, payment processing continues. If loan growth weakens, investment services and business banking may continue generating healthy returns. Diversification helps smooth profits across changing economic conditions. What makes this model so powerful is that most customers rarely notice it. They simply see convenient apps, faster payments, and financial services that fit into everyday life. Behind the scenes, however, each interaction contributes to a carefully designed ecosystem where countless small revenue streams combine into billions of dollars. But even this remarkably diversified machine faces one force capable of dramatically increasing profits, or wiping them out almost overnight: changing interest rates. For a bank, few forces are more powerful than interest rates. A small change announced by a central bank can ripple through mortgages, business loans, savings accounts, government bonds, and investment portfolios within days. To the average person, it might sound like another headline on the evening news. To a bank, it can mean the difference between record profits and serious financial stress. At the heart of this relationship is something called the net interest margin. The concept is surprisingly simple. Banks earn money when the interest they receive from loans and investments is greater than the interest they pay to depositors and other funding sources. That gap, multiplied across billions of dollars, becomes one of the industry's most important profit engines. Imagine a bank paying customers 2% on their deposits while lending that money at 6%. The 4% difference doesn't sound dramatic until you remember that the calculation isn't happening on thousands of dollars. It's happening on billions. Even a slight improvement in that margin can translate into hundreds of millions of dollars in additional earnings. But the equation doesn't always move in the bank's favor. When central banks rapidly raise interest rates to fight inflation, borrowing becomes more expensive. Families delay buying homes, businesses postpone expansion plans, and demand for new loans begins to slow. At the same time, customers expect better returns on their savings, forcing banks to pay more to keep deposits from moving elsewhere. Suddenly, profits face pressure from both directions. Higher interest rates can create another challenge that many people never consider. Banks often invest in government bonds and other relatively safe securities. If those investments were purchased when interest rates were much lower, their market value can fall as newer bonds begin offering higher yields. On paper, a bank may suddenly appear less valuable, even if the underlying assets remain reliable over the long term. Now add one final ingredient: public confidence. If customers become worried about a bank's financial health, they may rush to withdraw deposits all at once. Even institutions with strong long-term assets can struggle if they're forced to sell investments quickly to meet overwhelming demand. History has shown that panic can spread faster than financial problems themselves. This is why trust is arguably a bank's most valuable asset. Deposits, loans, technology, and investments all matter, but confidence holds the entire system together. Lose that confidence, and even a profitable institution can face extraordinary challenges. So if running a bank requires managing deposits, loans, fees, risk, regulation, and public trust all at the same time, why do investors still consider banking one of the world's most attractive businesses? The answer lies in how all of these pieces combine to create an extraordinary economic machine. By now, the picture is much clearer. A bank isn't just a place where money is stored, and it isn't simply a company that lends cash. It's a business that combines inexpensive funding, disciplined risk management, technology, customer relationships, and scale into one of the most efficient profit models ever created. Each individual piece is valuable, but together they form a system that becomes more powerful as it grows. Start with deposits. Millions of customers provide banks with a stable source of funding every day. Those deposits support loans that generate interest income, while payment services, wealth management, business banking, and investment products create additional revenue streams. Instead of relying on a single product, banks earn money from dozens of connected financial services that reinforce one another. Scale makes this model even stronger. A small community bank and a global financial institution may offer many of the same products, but the larger bank can spread technology costs, compliance expenses, and operational infrastructure across millions of customers. As more people join the system, the cost of serving each additional customer often falls while opportunities to generate revenue continue to grow. Technology has accelerated this advantage. Mobile banking, digital payments, automated fraud detection, and data analytics allow banks to process enormous volumes of transactions with remarkable speed and efficiency. Every interaction helps the bank better understand customer needs, improve services, and strengthen long-term relationships that can last for decades. Perhaps the greatest competitive advantage, however, is trust. People deposit their salaries, finance their homes, build retirement savings, and run businesses through institutions they believe will still be standing years from now. That confidence creates an economic moat that is incredibly difficult for new competitors to replicate, even with better technology or lower prices. Viewed this way, banks aren't merely financial companies. They're critical infrastructure supporting almost every modern economy. Every paycheck deposited, every mortgage approved, every business expanded, and every payment processed flows through systems that banks have spent generations building and refining. Once you recognize how these pieces fit together, it's impossible to see a bank as just another business. Instead, you begin to understand why some of the world's largest fortunes have been built around banking, and why the biggest lesson isn't simply how banks make money, but what that knowledge means for your own financial decisions. At the beginning of this video, we imagined a business where people voluntarily hand over their money, expect it to remain available at any moment, and unknowingly help generate billions of dollars in profit. It sounded almost too good to be true, but now you know that this isn't a thought experiment. It's the business model that powers modern banking. The biggest lesson isn't that banks are secretly taking advantage of people. Banks perform an essential role in every healthy economy. They help families buy homes, allow businesses to expand, make everyday payments possible, and keep money flowing where it's needed most. Without banks, economic growth would slow dramatically, and many of the financial opportunities we take for granted simply wouldn't exist. What changes once you understand the economics is your perspective. You begin to realize that your savings account isn't just a safe place to store cash. Your paycheck isn't simply being held until payday. Every deposit, loan payment, card transaction, and investment decision becomes part of a much larger financial ecosystem built around trust, liquidity, and the movement of capital. This knowledge doesn't mean you should stop using banks. It means you should start using them more intelligently. Compare interest rates instead of accepting the first offer. Understand the true cost of borrowing before signing a loan. Make your savings work harder. Recognize that every financial product has a business model behind it, and the more you understand that model, the better your decisions become. The most financially successful people don't necessarily have access to different banks. They simply understand how the system works better than everyone else. They know when debt can create opportunity, when cash should be earning more, and why small financial decisions compound over years into enormous results. So the next time you walk past a bank or open your banking app, don't think of it as a digital vault protecting your money. Think of it as one of the most sophisticated economic machines ever created, one that quietly powers businesses, governments, and everyday life around the world. Because in the end, the greatest financial advantage isn't having more money than everyone else. It's understanding how money really works, and using that knowledge to make every dollar work harder for you.